we'll leave some time for questions. Mary will answer the hard questions, and I'll take the softball. After all, she's a George Mason University graduate. I did note that with 40 people in the room, the quick mental math is I can't remember another group where 5% of the people in the room have been George Mason University graduates. That's duly noted. I was pleased that he didn't say anything negative about Iowa State University that hasn't had a winning football team since well before my grandfather went to school. But anyway, I will go through some programs, answer questions that you may have, and the programs are pretty simple. Farm Act 1 and Farm Act 2. You can tell we weren't particularly creative in our naming of our programs, but there are subsets to each one. And I'm going to start with the last one and work backwards. The last one is Farm Act 2, and under our statute, we purchase the guaranteed portion of many of the USDA guaranteed loans. So for those of you in agriculture, that can mean a farm ownership loan. For a younger beginning farmer, that can mean an operating loan of certain characteristics. It does not mean rural housing. We don't have the authority to purchase the rural housing loans from USDA, but we have a pretty robust purchase program. And you say, well, what's that all about? Well, a lender, as Mary said, the primary lender, would make a loan to a family farmer or rural resident that's a USDA guaranteed loan, including community facilities, firehouses, daycare, elder care. Those are all in the bandwidth of what can qualify for USDA. So the lender may want to make that loan, does make the loan, but wants to sell the loan, or the portion is guaranteed, and then use the money to make more loans, called liquidity. So we provide liquidity to those lenders in rural areas. We bought loans from over 800 of them, and we do that on a regular routine basis, something to the tune of about $25 million a month. And we do that on a daily basis. So a lender in Pennsylvania was mentioned, that might have a community facility, firehouse, they get a 90% guaranteed loan, the bank keeps 10%, and they want to sell the 90%. And they do that, and we buy that, and then give them the cash, and they make more loans, presumably, with that money. That's our Farm Act 2 program. Our Farm Act 1 program is where we buy whole farm loans. We'll touch on rural housing in a minute, but for a bank, again, that might have a farmer, rancher, that wants a farm loan, a mortgage loan, a first mortgage loan is all Congress chartered us to do. We buy those, we again give the lender cash for those loans. The lender maintains the storefront, if you will, to that borrower, so the borrower's interests don't leave town, so to speak. But behind the scenes, we buy the loan, the lender gets the money, and the lender makes more loans. The lender's particularly motivated because of what we call a more traditional funding that you see today, which means short-term money, the money that's 1-year-old, 2-year-old, 3-year-old loans in term is pretty cheap. But the further out you go, if you want a 10-year fixed loan to 50 and a 20-year fixed loan, a normal commercial bank in your community has trouble doing that. Because on the other side of it, where do they get their money? They get them from CDs and deposits and checking account balances, and those are all short term. You're not willing typically to buy a 10-year CD that allows your banker to go in and make 10-year. So that's where they look to us. So for those farmers, farm families that want a 15-year, a 20-year fixed rate loan, the banker makes it, sells the loan to Farm Act because we offer those length of term loan. So that's the high-speed version of Farm Act 1 and 2. We also, as you go, a lot of our day-to-day lenders that access the program are community banks, those that you would see in your vicinity every day. But there are also others involved in agricultural lending that are not particularly community banks. They might be the Bank of America, the Wells Fargo Bank, the Key Bank. They might also be insurance companies. MetLife Insurance makes farm loans, Prudential Life does, the Hartford does, and so on. Those lenders also use our programs. Again, sometimes to provide, with us providing enhancement, buying their loans, or agreeing to buy at a future date. So it's all about first mortgage loans getting pledged to access better funding for the end user out front in the community that's a farmer or rancher. We mentioned rural housing or housing in rural areas, and I'd say to you, Congress gave us the authority. Again, if a loan is small, if the collateral for a loan is small in size, 5 acres, as small as 5 acres, and has a home on it, we can consider that as a farm loan, and we do. So there are a lot of, you might call a hobby farm loan, a part-time farm loan. Someone lives in the country, has a few acres, maybe they have some beef cattle on it, maybe they rent it out to a neighboring farmer and they work in town. We have a lot of those kind of loans. But in terms of the traditional, what you call rural housing loans, a house, nothing agricultural going on in the property, might be in a small town, 2,500 or less, might be in a rural area. We really don't do any of those, and there's a simple reason. Fannie Mae and Freddie Mac for years has the ability and have been making those kind of loans. And Fannie Mae and Freddie Mac have certain market advantages up to this point, at least up to last fall, which is their access to debt. They can get money cheaper than we could. And that's because simply their heft. They would issue billions and billions of dollars in the market. Our total book of business is $10 billion. So at any given time, we're a much, much smaller organization. And that means something in terms of what it costs us to rent money so we can, in turn, can rent it out and use it. So the rural housing piece has never been much of what we've done. We have in the hobby farm piece about $325 million, I think, roughly, in those kind of loans. People live in the country, work in town, and have something agricultural going on the property. Those loans, just ancillary, are performing very well. I mean, we just don't have the kind of issues that you read about in the headlines, partly because we never did subprime lending. We always got full credit information from the customer. They always had to have a good, sound credit history, and the result is we have loans that perform. Part of it is, too, if you know of anyone that's on those kind of properties, they tend to be more a dream property. In other words, people, that isn't typically their first home, it's the one in the country with 15 acres. This is typically a move-up home. They've been homeowners for a while, and it's their dream to live in the country for lifestyle reasons. And as a result, they perform better and they take more care with their credit historically. So that's the Farm Act 1, Farm Act 2. We vet, so to speak. The lenders have to apply to be able to sell us loans. We want to make sure that they have the skill set to work effectively with the farmer. They know what they're doing. They can service the loan, meet the needs of the farmer. So we check all those things. We check the financial stability of the bank that sells us a loan or the insurance company to make sure that they can stand behind the representations that they make to us about the loan. Mary, what did I miss? I'm going to feel so I need to stop and take questions.
Rural utilities, and maybe talk about ethanol and some of the dairy issues we've had.
Yeah, we can talk about commodities. And then, good point, I'll talk about rural utilities. In terms of what we do and how we reach lenders, and I'll get to the point about what lender feedback has been, to your point of is credit available out there. We attend somewhere upwards of 24 meetings with state banking organizations. A lot of those have happened this spring. They're happening right now. We've got people out on the ground with those. And I can tell you that the American Banking Association and the Independent Community Banker Association both say the same thing. Their banks have money available for farmers. They want that message out loud and out clear. I would say that if people have speckled credit or haven't taken care of their affairs very well, they have less access to credit than they would have 2 years ago. When the rocky and rolling times of the past 5 years, there wasn't much differentiation between someone that took very good care of their credit and someone that took less good care of their credit. And that, so if, in some instances, when you hear, well, credit is dried up, what it means is for that lower tier that haven't performed as well historically, and the credit isn't as readily available, and for sure, it costs more. In other words, the interest rates are high. So the banking community stands ready, as does the farm credit system, stand ready to meet the needs out there. I would say that the insurance companies have, some of them have opted to stand on the sidelines because they're funding people on the deep of the bowels of the insurance company, don't have funds or have funds to invest in other places where they can get a better return than loaning money out to farmers and ranchers. So they have moved to the sidelines, but that's not atypical. They've done that over the years as well.